Welcome to the Opening Bell Report.
Okay, let's unpack this. It is the weekend of February 8th, 2026, and if you were anywhere near a stock terminal or, a crypto chart on Friday afternoon, you didn't just see a green candle.
No.
You saw an absolute explosion. We are talking about Strive Inc., ticker symbol ASST.
It was the kind of price action that forces you to stop scrolling, put down your coffee, and actually open the chart just to see if your data feed is broken.
Exactly. The stock absolutely ripped up over 20% in a single session, closing right near $12. The volume was just deafening.
Insane.
But here is the thing, and this is exactly why we are jumping into this deep dive today. The chatter isn't just, hey, nice gain. The chatter is specific, and it is loud.
Very loud.
Everyone is asking one very specific question. Is this the next MicroStrategy?
It's the billion-dollar question.
Yeah.
Literally. And it's the question that could, define the next phase of this bull market.
We all know the playbook, right? MicroStrategy set the standard for holding Bitcoin on a corporate balance sheet. They are the giants. But now, Strive Inc. has planted a massive flag in the exact same territory.
Right in their backyard.
So our mission today is to look past the hype. We are going to tear down a specific analysis report from Strive Inc. titled The High Beta Bitcoin Strategy of AST.
And we need to be critical here, because on the surface, looking at a chart that goes straight up, this looks like a copycat trade. It looks like someone saying, hey, they did it, let's do it too.
Right.
But when you look at the mechanics, the how and not just the what, the report suggests Strive is actually doing something structurally different from MicroStrategy.
And that's the hook. Is this a genius leverage play, or is it a house of cards built on a bull market? We need to look at the engine under the hood. But let's start with some context, because if you haven't been watching Strive closely, you might be confused.
Very confused.
Until very recently, this wasn't a Bitcoin company at all.
No, not even close. And that is such important context to understand the volatility. I mean, if you rewind the clock, even a year or two, Strive was a digital marketing firm.
A digital marketing firm.
It was essentially a penny stock, just drifting in what we often call operational obscurity.
Talk about a hard pivot. How do you go from selling digital ads to holding a treasury that rivals sovereign nations?
It's a total metamorphosis. The analysis report details what they call the cleanup phase. To get to Friday's price explosion, they had to execute a series of really aggressive financial maneuvers.
Okay.
First, they had to shed that penny stock skin.
Which explains the reverse stock split. Now, usually when I see a reverse split, I run the other way. It often feels like a desperate move just to stay listed on an exchange.
Often, yes. You are usually right to be skeptical. But in this specific context, the report argues it was strategic signaling.
Signaling to who?
Think about who buys MicroStrategy. It's not just retail traders on their phones. It's pension funds, endowments, large asset managers.
The big money.
The big money, exactly. And the big money has rules. Many of these funds have strict mandates that literally prohibit them from buying a stock if it trades under $5.
It's like a velvet rope.
It is. By reverse splitting and pushing the price up, Strive essentially unlocked the door for institutional capital to enter the room. They put on a tuxedo so they could get into the gala.
Okay, so they dressed up the share structure. They look presentable to Wall Street now. But you can't buy Bitcoin with a clean share structure. You need cash.
Cold, hard cash.
And lots of it.
Loads of it. And that brings us to the catalyst for Friday, February 6th. The move wasn't just vibes or sympathy with Bitcoin price.
No, it was a real event.
It was the completion of a massive $225 million capital raise via preferred stock.
$225 million. For a company of this size, that isn't just a raise, that is a war chest.
It puts real firepower on the balance sheet. And when you combine that fresh capital with the fact that they have now fully integrated asset entities, and this is crucial acquired Semler Scientific, the market finally gave them the green light.
Right.
They aren't a marketing firm anymore. They are now a top 10 global holder of Bitcoin.
That stat blew my mind when I read it in the report. Top 10.
Yes. They are sitting on approximately 13,131 Bitcoin.
That is a serious stack. Okay, so we have the stock is up, they have a mountain of Bitcoin, and they have a war chest. But I want to drill down into the how.
Let's do it.
You mentioned the acquisition of Semler Scientific. The report uses a phrase to describe the strategy that sounds like something out of a horror movie.
It's dramatic, isn't it?
The vampire move. What on earth does that mean in a corporate finance context?
It's colorful language, but it's actually a very precise description of their accumulation strategy. The mandate comes directly from their CEO, Matt Cole, and it's explicitly modeled after MicroStrategy's Bitcoin per share metric.
Right. The idea that the most important number isn't revenue or profit or EBITDA, it's simply, does the amount of Bitcoin backing my single share go up or down?
Precisely. Now, how do you grow that stack fast? You can buy Bitcoin on an exchange, sure. You take your cash, you go to Coinbase or wherever, and you buy it.
But that's slow.
Too slow. Strive did something more aggressive. In January 2026, they acquired Semler Scientific. Now, Semler had an operating business, they made medical devices, but that's not why Strive wanted them.
They didn't want the stethoscope, they wanted the wallet.
They wanted the treasury. Semler held over 5,000 Bitcoin. By acquiring the company, Strive essentially drank the blood or absorbed the treasury of a competitor.
It's like Pac-Man. You eat the ghost, you get the points. But why buy the whole company? Why not just buy the Bitcoin?
Because of the arbitrage. This is the accretion part the report talks about. Sometimes a company's stock price trades at a discount to the Bitcoin they hold.
Ah, okay.
So let's just say Semler holds $100 million in Bitcoin, but their stock is trading as if they only hold 90 million.
So if Strive buys them, they are effectively buying Bitcoin at a discount.
Exactly. They acquire the company, liquidate the operations they don't want, and absorb the Bitcoin. The report notes that this is something even MicroStrategy hasn't done this aggressively.
Buying entire public companies just to get their crypto holdings?
Yeah. They're hunting. They are looking for other companies that have Bitcoin, and they are eating them.
That is the vampire move, absorbing a competitor to feed the treasury.
You got it.
That brings us to the inevitable comparison. If they are doing the MicroStrategy playbook, but faster and maybe even more ruthlessly, are they just a clone? Or is there actually a structural difference in how they are built?
There is.
Because the report mentioned something about SATA and preferred equity versus debt.
And this is the major structural difference. And if you are a finance nerd or just someone who wants to understand the risk, this is where you need to pay attention. The report describes Strive as leverage on leverage.
Okay.
But they aren't using the same tools as Michael Saylor.
Right. MicroStrategy is famous for using convertible debt. They issue bonds, borrow money at basically zero interest, and buy Bitcoin. It's been genius so far.
It has. Convertible debt is great because it's cheap. However, debt has a very strict downside. It has a maturity date, and it has interest payments, even if they are low.
And if the market crashes and your assets plummet,
Bondholders can force you into bankruptcy. It's a gun to your head.
debt is unforgiving. If you miss a payment, the bank or the bondholders, they take the keys to the house.
Exactly. Strive is taking a different route. That $225 million we mentioned, they raised it using preferred equity. The ticker for this instrument is actually SATA.
Why does using preferred equity matter versus using debt? Isn't it just another way to owe people money?
Not exactly. Preferred equity sits in a different spot on the capital stack. It pays dividends, not interest. And here is the aha moment that the report highlights.
Okay.
Unlike debt interest, which you must pay or you default, preferred dividends can often be deferred.
Wait, so they can just not pay the investors?
Well, it's not that they won't ever pay. The dividends usually accumulate. They stack up. But if there is a crypto winter and cash flow gets tight, they have the option to pause those payments without triggering a default or bankruptcy.
That is a massive safety valve.
Huge. The report calls it a safer form of hyper-leverage. It allows them to leverage the balance sheet to buy Bitcoin, just like MicroStrategy, but without that immediate threat of insolvency if the market turns against them for a few quarters.
Let me try to stick an analogy on this to make sure I've got it.
Go for it.
MicroStrategy is like taking out a mortgage to buy an investment property. The bank expects a check on the first of the month, no matter what.
Right.
If the tenant doesn't pay, the bank doesn't care. You pay, or you lose the house.
That's it.
Strive's approach with preferred equity is more like getting funding from a rich, eccentric uncle. He wants his return, and you promise to pay him a nice dividend. But if you're short 1 month because the market is down, he's not going to foreclose on your house immediately. He'll just say, okay, add it to the tab, pay me double next time.
That is a surprisingly accurate way to put it. It gives them breathing room. It changes the risk profile completely during periods of high volatility.
And in crypto, volatility is the only guarantee.
Always.
And speaking of volatility, we have to talk about the price action we saw this weekend. Strive didn't just move with Bitcoin. It moved more than Bitcoin. The report calls this the law of small numbers.
This is the core high beta argument. And it's simple math, really. MicroStrategy is a whale. We are talking about a market cap over $100 billion.
It takes a lot of capital to move a ship that big. You need billions of dollars of inflow to shove that chart up 10%.
Exactly. To move MicroStrategy's stock price significantly, you need the entire market to push. Now look at Strive, ASST. The market cap is around $1.5 billion.
It's a speedboat compared to an aircraft carrier.
It is tiny. And this also relates to the float, the number of shares actually available for trading. Strive has a lower float.
So demand spikes.
Like it did on Friday when the news of the capital raise hit. There just aren't enough shares for sale to satisfy the buyers. The price has to jump aggressively to find sellers.
So that explains the multiplier effect. If Bitcoin moves 10%, MicroStrategy might move 15%. But AST, because it's smaller and tighter, might rip 20 or 25%.
Correct. It acts as a high beta proxy. If you are bullish on Bitcoin, ASST offers you more leverage on that bet simply because of its size mechanics. It takes less money to send it to the moon.
But we have to be responsible here. Leverage cuts both ways. A speedboat can turn fast, but it can also flip over in rough water much easier than an aircraft carrier.
That is the trade-off, and the report is very clear on this. The high beta is a double-edged sword. If Bitcoin corrects, and we know Bitcoin corrects, AST is going to feel it much harder than MicroStrategy.
Much harder.
A 20% drop in Bitcoin could easily mean a 40% drop in AST stock.
So let's look at the bear case. We can't talk about 20% gains without talking about the risks. The report identifies two main dangers. The first one they call dilution addiction.
This is the concern with their funding model. Remember, they are issuing that preferred equity and new shares to buy Bitcoin.
Right.
They are printing paper to buy digital gold.
So the pie is getting bigger, but my slice is getting smaller.
Exactly. Now, this works beautifully in a bull market. As long as the Bitcoin price is skyrocketing, you don't care about the dilution because the value of the Bitcoin they buy outweighs the shrinking of your percentage ownership.
It's called accretive dilution.
Right. But the math changes if Bitcoin stops going up.
It breaks completely.
It does. The report warns, if a crypto winter hits, or if the Bitcoin price stagnates, shareholders get diluted with no way to recover value. Imagine they issue shares to buy Bitcoin at $100,000. Then Bitcoin drops to $80,000.
I own a smaller percentage of a company that is now worth less.
You end up with a microscopic slice of a pie that just shrank. That is the death spiral risk.
Okay, that's terrifying.
Yeah.
What is the second risk?
The second risk is what they call the sailor premium, or rather, the lack of one.
Talk to me about premiums. Why does this matter?
So when you buy MicroStrategy stock, you're often paying a premium. Sometimes you pay $2 for every $1 Bitcoin they actually hold in the vault.
Why would anyone do that? Why not just buy the Bitcoin yourself?
Because the market trusts Michael Saylor. He has a track record, he's battle-tested, he has navigated bear markets and come out stronger. The market pays extra for his ability to navigate the capital markets. It's a management fee, essentially. You're paying for the general.
Right. It's the trust me tax.
Strive currently trades at a lower premium, around 1.4 times its net asset value. They are the new kids on the block. The report emphasizes that this trust is fragile.
So they have to prove themselves.
Absolutely. Matt Cole and his team have executed the setup perfectly. The merger, the raise, the acquisition. But they haven't weathered a massive storm yet.
So if management makes one bad strategic move, or if the market just decides they don't like the cut of their job, that premium could collapse.
Instantly. The stock could crash down to trade at the raw value of the Bitcoin it holds. You would lose all that leverage premium overnight.
You are betting on the jockey as much as the horse here, and this jockey is riding his first steeplechase.
That's a fair assessment. They have proven they can build the machine, but can they drive it through a hurricane? We don't know yet.
So let's pull this all together. We have a massive Bitcoin stack, a vampire acquisition strategy where they are eating other companies for their coins, a preferred equity structure that acts as a safety valve against bankruptcy, and some very real volatility risks.
That's the picture.
The report gives a final verdict on whether AST is the next MSTR. What's the bottom line?
The verdict is yes, but with higher stakes.
High risk, high reward. So who is this actually for?
The report breaks it down by investor personality. If you are a conservative crypto investor, if such a thing exists, you stick to MicroStrategy, or you just buy the ETF.
You want to sleep at night.
Exactly. You don't need the stress of a small cap levered play.
But if you are looking for the juice...
If you are what the report calls a degen growth investor, AST offers the potential for 2 to 3 times the returns of MicroStrategy if the bull run continues through 2026.
Just because it's smaller.
Simply because it is starting from that much smaller base. It's the law of small numbers again. It is mathematically easier for a $1.5 billion company to double than it is for a $100 billion company to double.
Precisely. But you have to be able to stomach the drawdowns. You have to be okay with seeing red days that are very, very red.
That is the price of admission.
There is a line in the report that I think perfectly encapsulates this whole situation. I want to read it because it really stuck with me.
Let's hear it.
It said, MicroStrategy is the Bitcoin bank. Strive is the Bitcoin hedge fund.
It's a brilliant analogy. Banks are stable, reliable, massive. They move slowly, but they don't break easily. You trust them with your life savings.
And hedge funds.
Hedge funds are aggressive, nimble, and risky. They chase alpha, they take asymmetric bets.
And the quote continues, both are going to the moon, but Strive might just get there faster if it doesn't blow up the engine on the way.
And that if is what every listener needs to weigh for themselves. Are you looking for a bank, or are you looking for a rocket ship with an experimental engine?
It really makes you think about the evolution of companies in this space. We started with companies simply putting a little Bitcoin on the balance sheet as a hedge like Tesla did.
A toe in the water.
Then we got MicroStrategy turning the company into a Bitcoin vessel. Now we have Strive acquiring other companies just to harvest their Bitcoin.
It raises a pretty profound question about the future of corporate finance.
It really does, and that's the thought I want to leave you with today. We are seeing a blurring of lines. In a world where companies are increasingly becoming Bitcoin treasuries, at what point does the actual business operation, the marketing, the software, whatever they supposedly do, become completely irrelevant?
It's a valid question.
Yeah.
I mean, if the treasury makes more money in a week than the operating business makes in a decade, why even have the operating business?
Exactly. Are we looking at the future of corporate finance where the product is just a side hustle to the treasury? Or is this just a really, really sophisticated way to gamble on the stock market?
We might find out sooner than we think.
A huge thank you to the authors of the Strive Inc. analysis report for giving us the roadmap.
Don't forget to like, share, and subscribe for more.